Are we witnessing a sunrise for the retail volatility salesman?
Hello and welcome to today's Daily Blitz. In 2018, we experienced Volmageddon, where the VIX, the volatility index, spiked and wiped out a huge amount of retail investors. But Boaz, you're expecting the very opposite to happen next year.
Yes, that's quite right. So as I've explained in a previous video, in fact, I believe that next year, 2020, is going to be a remix, pretty much, of 2017. So we're going to see a lot of similar things going on. So back in 2017, there was a really big boom in a product known as the XIV, and the XIV was an exchange-traded note, an exchange-traded product that was created by Credit Suisse. Credit Suisse had made this thing because they wanted to allow investors to effectively get the opposite effect of the VIX. And what I mean by that is whenever the volatility index went down, the XIV was intended to do the opposite. And so you'd get this inverse effect when volatility went down. Those who owned the XIV would make an awful lot of money.
So what does that actually mean in terms of volatility? Can you explain the VIX index?
Right. So on the US stock market, there is an index known as the VIX, and that is regarding the pricing of options on the US stock market. So if you imagine that the cost of insurance against big moves, either up or down on the US stock market, can be hedged, can be insured away using options, what the VIX measures is just how volatile the pricing of those options are. So when people, or market participants in the options market at least, anticipate that there's going to be a lot of volatility on the US stock market generally, what they will do is start pricing options much more expensively. So the VIX is really a measure of just how expensive that insurance is on the US stock market. So when the VIX goes down, that is generally an indicator that market participants do not expect the US stock market to be volatile. They expect them to be sort of still and steady.
So the XIV is like a bet that there won't be volatility in the future.
Well, the XIV was a bet that things wouldn't be like that in the future. All of the investors who bought it got immolated in early February of 2018. So it got to the point where the VIX could double in value, go from 8 to 16, when the historical norm for the VIX is really around 20. So what would be really quite an everyday occurrence historically for the VIX would actually wipe out the XIV entirely. It was called an acceleration event. And what happened, as you can see in that very long near vertical line on the right-hand side of that chart, is that effectively overnight all of the people who owned the XIV took really a 90% or greater haircut on their money. It was really brutal, but they did manage to make an awful lot of money beforehand.
So are you predicting a repeat of Volmageddon, or are you expecting a repeat of this bear market in volatility?
Right, so I think with central banks now acting in concert together to raise asset prices and keep the wheels on of the financial system around the world, that effectively we're going to get a big bull market in all manner of risk assets. And as the stock market is known to take the stairs up and the elevator down, that means low volatility as a whole. And what that also means is that inverse volatility products, like the one I absolutely hated, will do very well. So the XIV doesn't exist anymore, but there are inverse volatility products out there. And while it is an incredibly risky bet to make, I would say, and I predict in fact, that in next year they will do very, very well, simply because central banks are trying to crush volatility all across the board.
And you would call this the sunrise on the retail volatility salesman.
So as early 2018 illustrated the sunset, I believe 2020 may well be a time for a sunrise of the retail volatility salesman.
And that sums up today's Daily Blitz. Thanks for watching.